Welcome to The Explainer. Today we're diving headfirst into the absolutely chaotic 2026 gold market. From massive global price shifts to some really crucial domestic tax changes, we're going to look at the data, map out the policies, and bring some absolute clarity to your precious metal strategy. All right, let's just jump right into it with this staggering number, $5,589.38. That is the all-time high that gold hit per ounce on January 28, 2026. Just take a second to process that figure. It sets the massive stakes of the current global market, and honestly, it proves that the rules of precious metals investing are actively being rewritten right in front of us. So, we've got a lot of complex ground to cover today. First, the 2026 gold price boom. Second, drivers of the gold rally. Third, SGBs, suspended and taxed. And finally, navigating gold taxes. Section 1. The 2026 gold price boom. Record-breaking prices. Okay, so gold has been on this just incredible trajectory over the last year. I mean, in 2025, it saw a massive 65% annual gain. Our sources note that's actually its strongest performance since 1979. It literally set 53 new all-time highs. Then, January 2026 rolls around, and it smashes right through the $5,000 mark, eventually peaking at that $5,589 high. Now, yeah, in March, we did see a 13% pullback to around $4,867, but, major institutions are really looking at this as a consolidation phase, a solid entry point, rather than any sort of structural retreat. And the big players? They are incredibly confident this bull market is far from over. JP Morgan is leading the pack with a super bullish call of $6,300 an ounce by year-end. UBS is right on their heels at $6,200. Even Goldman Sachs, taking the most conservative stance here, is still targeting a massive $5,400. The consensus is pretty clear. The momentum is here to stay. Section 2. Drivers of the gold rally. A structural demand shift. So, what's actually fueling these wild forecasts? Well, it boils down to 5 massive macroeconomic forces. First up, central bank demand is just off the charts. We're talking 863.3 tons bought up in 2025 alone. Second, there's aggressive de-dollarization happening, heavily led by emerging markets like China, Poland, and India, who are literally swapping out US dollars for gold. Third, expected Federal Reserve rate cuts are dropping the opportunity cost of holding a non-yielding asset. Fourth, we're seeing record ETF inflows, like $89 billion in 2025. And finally, there's what Goldman Sachs calls the debasement trade. This is institutions hoarding physical bars to hedge against rising sovereign debt and fiat currency erosion. Basically, gold isn't just a simple crisis hedge anymore. It's fully transitioning into a foundational reserve asset. Because of all this, central banks are now the dominant marginal buyers of gold. And that means the old rules kind of go out the window. See, these institutional buyers, they don't panic sell on a bad Tuesday. They accumulate. And because they buy and hold, it essentially establishes a much, much higher permanent price floor for the entire market. Now, to keep things totally objective, we do need to look at the whole board and note the potential headwinds. What could actually reverse this trend? Well, a hawkish pivot by the Fed raising rates, for one, or maybe a sustained rally in the US dollar, a sudden peaceful resolution to global geopolitical risks, or a massive unwinding of speculative profit-taking. Any of those could definitely drag prices down. But the reality is, major analysts believe you'd need several of these events happening simultaneously to actually break the current bull case. Section 3. SGBs, suspended and taxed. Budget 2026 tax changes. Let's bring this back home to domestic policy and see how this global gold rush directly impacted India's absolute favorite paper gold scheme. Sovereign gold bonds, or SGBs, were introduced back in November 2015 to pivot investors toward paper gold, and wow, did it work? The government raised over 72,000 crore rupees. That is roughly equivalent to almost 147 tons of gold. But then, out of nowhere, early 2024, they suddenly stopped issuing new tranches. And now, the April 2026 budget changes are completely rewriting the playbook. So why did they hit the brakes? Basically, SGBs turned into an incredibly expensive form of borrowing. Think about it. The government realized that paying a guaranteed 2.5% fixed interest rate, right, on top of having to shell out for the massive capital appreciation of the gold itself at maturity, was just becoming way too costly to maintain. And this leads us to the absolute biggest shocker from Budget 2026. The government totally flipped the script on who gets tax benefits. If you're an original subscriber, meaning you bought the bond directly from the RBI issue and you hold it all the way to maturity, your capital gains remain totally tax-free. Awesome. But if you go and buy that exact same SGB on the secondary market today through a stock exchange, they killed the tax-free maturity benefit. Secondary market buyers are now hit with a 12.5% capital gains tax when they redeem. Also, just to clear up any confusion on this, that tax exemption we just talked about, that is strictly for capital gains. The 2.5% annual interest payouts you get have always been and absolutely will continue to be fully taxable under income from other sources. That gets taxed right at your regular income slab rate, and that applies whether you bought it straight from the RBI or off the secondary market. Section 4. Navigating gold taxes. Tax implications. So with SGB benefits slashed and global prices soaring, how do you actually handle the tax implications for every other type of gold investment? Well, the rules cleanly dictate exactly when your investment shifts from being taxed at short-term slab rates into that flat 12.5% long-term capital gains bracket. For physical gold, digital gold, and gold mutual funds, you've got to hold the asset for more than 24 months to lock in that 12.5% rate. But if you're trading gold ETFs or picking up SGBs on the secondary market, you actually only need to hold them for more than 12 months to qualify. Now, I want to quickly clarify a really common misconception we see all the time regarding digital gold. Having digital gold on an app on your phone doesn't give you some magical tax loophole. The government treats it exactly like a physical gold coin sitting in a safe at your house. If you sell it before 24 months, it's a short-term capital gain taxed at your income slab. After 24 months, it's 12.5%. It really is as simple as that. Which brings us to the final and honestly the most important question today. As central banks systematically hoard gold to hedge against fiat debasement, and as governments literally rewrite tax codes to protect their bottom lines, is your portfolio actually prepared for this new era of precious metals? It's a crucial question you need to be asking yourself as the rules of the game shift in real time. We hope this explainer has given you the structured clarity and the hard data you need to confidently navigate the 2026 gold market. Stay informed, stay ahead of the curve, and we'll catch you next time on The